Thank you all for coming. Look, I spoke to the VET coordinators meeting around about a month ago, and I actually started with some statistics. So that's how I wanted to start today. I wanted to run by you a measure of the average retirement balances for males and females. And this survey was conducted by ASFA, which is one of the associations of superannuation funds in Australia. Now, the figures for males in 2005-2006 was $136,000 was the average retirement balance, and for a female it was $63,000.
When you say retirement figure, it's like the total super.
That's their superannuation balance.
And what year was this?
So you look a bit frightened, which is.
On the other way
Oh,
around.
okay, yeah.
How much is it for women? Sorry.
So this was a study in 2005-2006. So it's a little bit old. Now, they measured it again 6 years later in 2011-2012. Now, the figures had grown to, for males, 197,000, and for females, 105,000. So, you know, bear in mind, that was only 3 years ago, that study. So, you know, it's a little bit alarming that people are not retiring with enough in superannuation. And we would like to prevent that for this next generation of students. So obviously, superannuation guarantee was introduced in 1992, so a lot of those people would have started their careers well and truly before superannuation guarantee was introduced. So we do understand that those figures will increase for students of today who go into the workforce and spend their whole careers receiving super guarantee contributions. But at the same time, we want to make sure that those students really maximise what they're able to retire with. So we merged with Westscheme. Some of you may have heard the industry fund Westscheme. We merged with them in 2011, Australian Super. So now we have a division in WA called the Westscheme Division of Australian Super. Now, when we merged with Westscheme, we continued a sponsorship that they had in place for some time. It's now been going for about 14 years. So we actually sponsor the VET Awards, or the VET Awards, and we also sponsor the Beasley Medal for VET. So we are really happy to continue that sponsorship in the fund today. But we do see that there's an opportunity to actually extend that sponsorship out and provide sessions in schools. So financial literacy sessions in schools. And when I ran this by the Curriculum Council and then by the VET coordinators, they really saw potential in this. So what I wanted to do today was take you through the sort of presentation that we would provide to students in schools. And I've got copies of the presentation here for you to take later. Now, bear in mind, there's around about close to 50 slides in here, and I'll get through them relatively quickly. But we don't have to show, if we didn't have time to show that length of session in a school or in a class, you know, we could break it down into the components that you feel would be the most worthwhile to show to your students. So just a little bit about myself. My name is Linda Burns, and I'm an education manager with Australian Super. I've been in superannuation for 15 years, and it's really heartbreaking to me when I speak to members who are over 60 years old and still don't have any idea how they're going to fund their retirement, or even have any idea how much they need in retirement. So I think that this is something that has really been lacking in their past, just a basic understanding of, you know, not only, you know, what the types of subjects that they learn in school, but just basics of how to manage your own finances personally. So this is basically what this presentation is about. So sorry, that's okay.
I was just saying this is really good for a County 11.
Oh, good, good. Well, look, I've already gotten an engagement to speak on the 20th of August to a school, which I'm thrilled about. So, you know, do take this on board, and please let us know if we can help out with that. So, look, before I start, I need to let you know this is general advice only. So this is something that I would also have to do in the classroom. I'd have to let them know that I'm not providing personal financial advice. Okay, so the presentation is basically broken down into two sections. So firstly, we talk about savings and credit and banking, and then we touch on superannuation in the second part of the presentation. So the types of things that we touch on are basic things like set savings goals. So no matter where they are in their lives, they can set savings goals. Now, initially, they may want to look at a budget, and we certainly don't expect a student to start up a very complicated budget or to get serious about something like that. But what we do want them to understand is where their money's going. I think all too often people just spend what they earn and they don't really know where their money's going. So if you can start early by just keeping track of exactly where your money's going, that can give you a much better understanding of exactly what you need down the track in retirement. We really stress the importance of paying off personal study-related or credit card debt, and we talk about getting caught up in debt traps later in the presentation. And then eventually to love your superannuation, because we really want them to take ownership of superannuation. All too often we see people who don't give superannuation a second thought. It's just one of those things that they see on their pay slip, a little line that says, you know, this is where your super contribution's gone, and they pay no attention to it whatsoever. And they can go through years of doing that, and really, that's the worst way to treat your superannuation. So you really want to treat it like an asset. So we want to stress how important it is to treat it as an asset. We talk to them firstly about short, medium, and long-term goals. So for instance, a short-term goal may be mobile phone costs. So most students have mobile phones these days, and to be on top of mobile phone costs. In the medium term, they may want to plan a trip. So for instance, once they finish school, they may want to go on a long trip, and that requires putting away some money for and saving for. We also talk to them about cars and car loans, because that can be the next big asset that they go to buy. House deposits in the long term, and we all know that that requires a lot of money these days, particularly in Perth. So we really want them to understand that it's important to save for you know, a house deposit. So starting a savings plan, we don't expect that they will do anything fancy. We just want them to understand that, look, it doesn't take much for things to add up. So even if you decide to give away, take away food, that can add up to about $2,000 a year, and that can buy you a smartphone, you know, and a good plan. So, you know, little bits do add up over time. It's about, you know, being aware of what you're spending on a regular basis. One of the best websites out there is Money Smart. Now, this is a website that I can see a few people nodding, so obviously a few people are aware of Money Smart. It's a terrific resource, and it's really great because it's got sections for different age groups. So there's a section for under 25s, which is a really useful way for them to get used to what to look out for, you know, how to compare products. There's great calculators on the website. They're really easy to use. So if they can get used to just using tools like that and looking at websites like that, they'll be a lot more informed about finances generally. So then we talk about credit, and we bring them through a little scenario about a couple of friends who are going to go on a big trip, and this trip is going to cost them $5,000. And we do a comparison between Jess, who saves about 2/3 of the cost of the trip before they go and puts the other third on credit, as opposed to Lee, who doesn't save anything for the trip. So it's all too easy to apply for a credit card and then simply put the whole cost of something on a credit card and then just pay the minimum repayment every month. So we do a comparison between the two. Now, at the end of the day, in the first year, the interest rate is 12%. So you can see that the difference between them is around about $450, which isn't a huge amount. But if you have a look at Lee, who doesn't save anything for that trip, her initial principal borrowed was $5,000. Now, if she repays the minimum each month, her interest means that she pays back almost double the amount she initially borrowed, and it takes her 19 years to pay off that loan, which is just staggering, really. And you know, if people put credit or put things on credit cards and do this for a number of things, that can just spell disaster. So, you know, it's little lessons like that that they can really benefit from. So then we tell them, you know, what they can do if they do find themselves in a situation where they are carrying a lot of debt and they're not able to repay the debt. There's actually a financial counselling number, Money Smart runs. So, you know, there's resources like that out there to help people who are in that type of situation. So it's being aware of what options they have. We then tell them about things like an app called Track My Spend, which actually tracks what they spend. And even if they don't want to be really strict about it, I mean, I myself tracked what we spent for 12 months, and it requires a lot of dedication. You know, when you're looking at every single cent that's going outside the household for 12 months, and bear in mind it was only 2 of us, I didn't have kids I had to keep track of, but at the same time, that requires a lot of dedication to sort of, you know, continue to fill in a spreadsheet all the time, even though it's a very, very simple spreadsheet. But at the end of the day, I'm so aware of what our costs are. And it's really just knowing that. People don't have to do anything sophisticated, but just knowing what your money is being spent on. We talk about credit card calculators. Now, there are websites that you can compare products on. So if you're looking to get a credit card, we refer them to those websites. And it really pays to do some research on what product you're using. Obviously, products vary greatly. Through the presentation, we also take them through quiz questions. So we'll ask them something like this. If Sam has $3,000 owing on his credit card at 16.5%, if he pays only the minimum payment each month, it will take him 4 years to pay off. Well, no, the answer is actually it takes him 21 years. So, you know, we have a lot of giveaway items in Australian Super, and we talk to a lot of members in the fund. So what we tend to do is when we ask questions like that, whoever answers the question will give them a giveaway item. So, you know, we interact with them. Another question, a big retailer. Now, this is a trap often people fall into. A big retailer offers interest-free terms for 24 months. And if you make the minimum repayments, you actually are in a situation where that interest-free period isn't interest-free at all. So, you know, we want them to be aware that there can be some pretty misleading types of advertising about credit cards and debt out there. We then talk to them about banking and what to look for when they compare banks. So, for instance, not only to look at the fees, but also the interest rates and the penalty rates. Shop around, ask questions. There's websites like CanStar that are good websites to have a look at to compare banks. Then we run them through a couple of quiz questions about banks and finances. So again, we focus on how long it takes to make loan repayments. Is it better to pay things off quicker? And obviously the answer is yes. So better to pay fortnightly rather than monthly. Another quiz question about a car loan. Look for the comparison rate, not just the monthly repayment. Okay, so we just want them to be aware that there are scams out there, and in this day and age, most people know that. So, okay, so now the second part of the presentation is about super essentials. So we don't get too complicated about superannuation, but we do want them to be aware of investments, what SG contributions are, who they're paid to, how they go about choosing a fund at their first job, extra contributions, combining accounts, and insurance. Insurance is often the forgotten extra in a super fund, and often people don't actually even know they have insurance. So we talk to them about all of those different aspects. So we start off by telling them that there are a few things they need to be aware of when they start work. One is to, when you join a super fund, make sure that your tax file number is provided to the fund. because if you don't provide that tax file number, you'll be taxed at a much higher rate than you would otherwise be. So it's 49% as opposed to 15%, which is a massive difference. We then tell them what they need to do when they start work. So we actually have a picture of the choice form in a couple of slides, but the choice form is something they just fill in. They would want to, and I do talk about having one super fund. If they can avoid having multiple super funds, that's the best way to have superannuation, because you're paying fees on every fund that you have. So you don't want to be in a situation where you're losing money that you could avoid. We talk about savings goals again, and if they can add extra to superannuation, we describe the differences between the after and before tax contributions, and that it's a great way to save for their retirement. And often they don't even miss it if it's a salary sacrifice contribution. So firstly, it's about choosing a good super fund. So when they start work, at the end of this presentation, we get them to go through an activity where they actually compare super funds. We've got a tool on our website that they can use that will actually compare super funds against our fund, and it's an independent ratings company that provides that report. So firstly, we say, well, look for fees. Fees are one of the biggest things that can affect your retirement balance when you have your super in a fund. Investment performance is another big aspect of how your retirement savings are going to grow. And then insurance options. So in a super fund, generally speaking, people will get insurance. They'll get a default amount of insurance, and we want them to know to have a look at that insurance. Make sure that insurance is suitable for their needs. It may be that they all have different circumstances and they all need different amounts of insurance. A super fund will give a default amount to a particular age group. So we want them to be aware, firstly, they've got insurance and the options around insurance. So have a look at those three things when they're comparing funds. Now, this is the choice form that they're given when they start work. So what they need to do is put down their details of the fund that they choose for their employer to pay into. So most superannuation funds actually allow you to join online. So if this is their first job and they are about to join a super fund, it takes about 10 minutes to go through the screens to create an account. It's a very quick joining process, and at the end of filling in the information in the screens, you actually get your member number immediately. So you can put it on the superannuation choice form and give it back to the employer, and immediately they'll have an account set up and the employer will start putting contributions into that account. Now, all they need to do when they go to their next job is repeat the process. They fill in the choice form, they've already got an account going, they put down their super fund details, and away they go. And it avoids this trap of having several different funds or having lost superannuation, in that lost members register, which is the case for so many people. So comparing super funds, we've got a tool on our website. It's called Apple Check. Now, this is provided by a company called Chant West, and they are a super ratings company. So they compare superannuation funds in the market, and it's an extremely easy tool to use. It's open to anyone. It's not just a tool for our members. And it's an unbiased report. So Australian Super has no, there's no bias in the report. So what they do is provide an email address, and that report will be emailed to that email address. It's a very simple report to read, but at the same time it's comprehensive. So it breaks down the super funds into the fees that they pay, the investment performance, how many investment options they have, what insurance they have, the extra services they have, and so on. So at the end of the day, it will award super funds a number of apples, up to 5 apples. And that's an indication of how good that company believes that super fund is. So this is a way for them to from the outset, choose a fund that suits them and where they've got the best chance of growing their super balances. So employers need to make super guarantee contributions for people who are eligible. So generally it's paid to those who earn more than $450 a month. That's a gross $450. They need to be at least 18, or if the person's under 18, they need to work 30 hours in a week in order to be eligible for super guarantee contributions. So immediately we'd like them to, once they join a fund, get online access to the fund, which is really easy. They just register their accounts online. From that point, they're able to track that they're receiving super guarantee contributions from their employer. Because we've heard pretty sad stories where members work for an organisation for a period of time and they're not aware that they're not being paid super contributions. You know, it's certainly not the norm, but it has happened before. So from the outset, they should be tracking that they're actually receiving the contributions that they're eligible for. So the contributions are paid at least quarterly, so we would suggest, you know, at least jump on the website quarterly and have a look that everything's in place. Now, then we talk about investments, and without getting too involved in the investments, certainly most of our members, we've got about over 2 million members in Australia. Most of those members are not that involved in their investments, even though everyone has investment choice. Most of them choose just to stay in the default investment option. So, but at least we want them to be aware of what their money is being invested in. So these are the assets that we invest in the fund. And then we go into a little bit of detail about risk and the different types of risk that these assets are associated with. So, for instance, we talk about short-term risk, which is more related to shares and property. And we talk about the fact that, you know, when you hear about the ASX shares going up and down, when you hear that in the media or on the radio, it's referring to you know, volatility and the fact that those investments are volatile, but we caution to say that over the long term, they earn the better rates of interest. We then talk about medium risk and long-term risk. So we talk about your money not keeping up with inflation, for instance, a conservative option like cash. And then we go through a couple of little diagrams about how, you know, we explain the short and the long-term risk. So the fact that, you know, you may want to go one way with your superannuation, but you may find in a bad year due to volatility and the share market's not doing well, that you actually find yourself in a negative position, which can be the case, as was the case during the GFC. We then talk about long-term risks. So at least make sure that your investment is keeping up with inflation. We talk about the fact that if they don't choose an investment option to be in, that's totally fine. They don't have to, but they'll be in the default investment option, which for us in Australian Super is the balanced option. So then we say to them that, you know, just at least if you're going to stay in the balance, or if you're going to stay in the default option of a fund, make sure you know what your super is being invested in. And then we have a couple of quizzes that we go through with superannuation as well. So when super returns have a bad year, it's generally best to roll your money into a cash investment option. Well, it's not really, and you know, we've got studies to prove that often people are worse off if they do that. So, you know, we talk about the fact that they need to have a basic understanding of that asset, that superannuation that they've got, that all too often is the forgotten asset. So we then talk about the fact that if they start early, they can make a massive difference to their superannuation. So we look at a little study between two people. Now these people contribute for a 10-year period. Now that it's the same 10-year period, all of the assumptions are the same. The person starting at age 25 puts in $50 a fortnight as opposed to the person starting at age 45 for the same 10 years, but they put in $100 a fortnight. At the end of the day, when they retire, each of them retire at 65, the person who puts in half the amount but starts 20 years earlier ends up with more money. And that's the magic of compound interest. So often a person who contributes that amount of money doesn't even miss it if it's done by salary sacrifice because of the tax effectiveness of a salary sacrifice contribution. So it's about learning the basics early and then reaping the benefits at the other end, because if they can have an appreciation of superannuation when they're really young, it really pays off for them, you know, when they retire. I just want to say that that quoted 49,000 for the super cutoff to receive government co-contributions. It's actually increased a little bit. It's just over 50,000 now. But we don't have that newest video ready, but I just wanted to make the point that, you know, there is co-contributions available, and obviously that'll be corrected if we do go into the schools. So, but, you know, it's an incentive that's there that people, if they know about it, they can do something about it, and they can increase their savings because of it. Now, here's another question. Adding a little to super regularly over a long term is generally better than adding one large lump sum. Well, obviously, it's true. Now, combining super is so easy these days. It's done online. It's very, very simple, and it's very quick. So we talk about how, firstly, you need to find lost super if you believe that you've got lost super in the system. Again, that's a really easy process. There's several websites dedicated to finding lost super. So if they just Google lost super, a couple of those will come up. They put in some basic details into a little search engine, and it will find any lost super they've got in the system. Having several super funds costs fees, and this is an example of how much more they're paying, having the same amount of money spread over 3 accounts as opposed to having them in one account. So it's these sorts of things that they need to be aware of early. We do caution them about combining accounts. They need to be aware of exit fees. So a fund can charge an exit fee by rolling out of a fund. So they need to know what that exit fee is going to be, and, you know, that they're happy to pay it. Also, insurance will cease when they roll out of a fund, so we want them to be aware that that happens, and to make sure that their insurance is in place with their current fund that they're rolling to. And then they can provide their tax file number as their ID. They don't need to go through the process of filling in a paper form and getting certified ID. That's all done away with now. So you just jump online, you go through a couple of screens, and you can just roll your super over, and it happens very quickly. The fund electronically messages the other fund, and the money is within the account within about 3 days. So it really is a very quick and easy process now. We then quickly just go through insurance. We offer 3 types of insurance. We want them to understand that they get insurance. I've met with members before that have been with the fund for years and don't actually know they have insurance in their superannuation fund. So what they actually have is a policy outside the fund, and they're paying premiums from their bank account that are being directly debited from their bank account. And they're amazed to know that they're doubling up. They don't even know that. So, you know, we want people to understand exactly what they have in the fund, also their options in the fund. So it's very easy to work out what your insurance will cost you if you need to vary it. You can increase it or decrease it, or even cancel it altogether if it doesn't suit you to have it. But the default is that you receive a particular amount depending on your age, so we teach them about that. And then again, we take them through another quiz question about income protection. So we really encourage people to get on our website. Members will have the easiest time dealing with their superannuation if they have online access. So from the outset, we think it's a great idea for them, as soon as they get an account, to register the account with a PIN number, and then they can get on and check the account regularly. So it's about teaching them to keep in contact with that asset. Superannuation could be one of the biggest assets they have. For people these days, it's one of the biggest assets they have, let alone for a student who's going to have superannuation for probably 40 years. So I think that if we can reach them early, they can really be equipped to manage their own finances easier than they otherwise would have been. I mean, I speak to people who are, you know, more my age group, and they think that it would have been terrific for them to have this type of service in the school, and to learn from the outset just some basics about managing their own finances. And certainly superannuation is part of that. It's not the whole picture, but we want to emphasize the importance of superannuation, because all too often members who are even getting close to retirement, it's still the forgotten asset. So, you know, we need to correct that thinking and really stress to people how important it is. We then, as a final topic, we get them to actually go through the activity. So we ask them to log on to the website, actually compare 3 super funds so that they know and are prepared for when they start that first job. They've done a little bit of research and they know what fund to choose. This is not all about Australian Super. Obviously, these are branded Australian Super slides, and I thoroughly believe that I work for a great fund. But at the same time, this is really teaching them the basics of financial literacy and not promoting the product as such. So we'd be more than willing to offer this to schools. Now, if demand gets too great, there's 2 education managers, myself and another in WA. If demand gets too great, I believe what the fund will do, and we've discussed this with them in head office, I believe what they'll do is produce a video that can be used by, for instance, remote schools, or if demand gets too great for the 2 of us to manage in the state. But the fund is more and more getting involved with younger people in Australia and rolling out things like this to more schools around the country. So if anyone wants to have a word to me and grab my card at the end, because if you do want to do something, please just contact me. And we can arrange to run it as you see fit. As I said before, it may be too long. I don't know how much time we'd be given in a classroom, but even if we pulled out the relevant slides, we could do that and tailor make it for you.